So you want to buy into the prestige of an elite private university? Before you pledge millions of dollars toward manicured quads, limestone arches, and Georgian architecture, take a hard, unsentimental look at IRS Form 990. Across the United States, roughly 41% of private nonprofit colleges and universities are running structural operating deficits, bleeding up to $45,000 a day in unhedgeable debt service. Data from S&P Global Ratings shows that the gap between top-tier Ivy Plus institutions and regional private colleges has widened to a historic precipice, with lower-tier private colleges facing an average operating margin of negative 4.2%. Yet, high net worth and upper middle class parents are still lining up to pay over $88,000 a year for their children's supposed networking privilege. The uncomfortable truth of upper middle class American culture is a deep psychological addiction to social proof. Families view an $88,000 annual sticker price not as the actual cost of higher education, but as a mandatory insurance premium paid to guarantee their child's entry into the economic elite. Make no mistake, elite private universities no longer function primarily as centers of higher learning. They are tax-exempt 501c3 commercial real estate holdings and hedge funds with a degree-granting appendage. High tuition does not reflect world-class teaching. It reflects the unsustainable cost of running a luxury residential resort disguised as an educational institution. On paper, it looks like an automated endowment building machine. In reality, it is a meticulously engineered liquidity trap. To understand how this financial machine traps well-meaning families, take Arthur Vance. Arthur is a successful small business owner living in an affluent suburban enclave in northern New Jersey. He spent 25 years grinding through 6-day work weeks to build a comfortable life, earning roughly $220,000 a year. To his neighbors, Arthur had made it. But in suburban America, upper middle class success isn't strictly measured by your liquid bank balance. It's measured by the bumper sticker on your SUV showing where your child goes to college. When his daughter received an acceptance letter from a prestigious, highly selective liberal arts college in New England, Arthur saw it as the ultimate validation of his life's labor. The sticker price was staggering, $84,500 a year for tuition, room, and board. Over 4 years, that represents $338,000 in post-tax capital, requiring roughly $480,000 in pre-tax earnings. Resigned, with his liquidity tied up in business inventory and real estate, Arthur did what millions of financially comfortable American parents do. He tapped into his home equity, pulling out a high-interest home equity line of credit at an 8.5% interest rate, effectively sacrificing his debt-free retirement to fund his daughter's golden ticket. Earnestly, Arthur genuinely believed that $84,500 reflected the direct cost of delivering an elite education, world-class professors, small class sizes, and groundbreaking academic resources. What Arthur didn't understand was that he had just fallen victim to one of the most sophisticated dynamic pricing models in modern corporate finance. According to data from the College Board, between 1992 and 2022, published tuition and fees at private 4-year institutions grew at more than double the rate of consumer price inflation. But this escalation isn't driven by rising classroom instructional costs. It is powered by a psychological marketing strategy known as the high-sticker, high-discount model. According to the National Association of College and University Business Officers, or NACUBO, the average institutional tuition discount rate for undergraduate students at private colleges reached a record high of 56.2% for freshman classes. Elite universities set an absurdly inflated sticker price to anchor a high valuation in the minds of wealthy consumers. They then apply an algorithmically calculated discount rate disguised as institutional merit scholarships or financial aid to price discriminate across income brackets. If a family is struggling, the school discounts the price just enough to secure enrollment. But if you are someone like Arthur, a business owner with home equity, you get squeezed for the full $84,500. The sticker price is not a reflection of what a college degree costs to produce. It is a luxury real estate positioning mechanism designed to extract a maximum capital from the upper middle class. To understand where Arthur's $84,500 actually goes, you have to examine the hyper-competitive arms race defining modern American higher education, the student life capital expenditure spiral. Over the past 15 years, private universities realized a terrifying truth about their core business model. In an era where academic curriculum is largely commoditized and accessible anywhere online, you cannot justify a top-tier sticker price through education alone. To attract full-pay families, colleges shifted capital spending away from academics and poured hundreds of millions of dollars into luxury lifestyle infrastructure. Take High Point University in North Carolina as a stark real-world case study. The university invested over $700 million into luxury campus upgrades, including fine dining steakhouses, an arcade, ice cream trucks, and hot tubs, specifically to boost enrollments and drive up tuition revenue. Across the country, institutions built $50 million athletic complexes, equipped with Olympic-grade climbing walls, lazy rivers, and indoor turf fields. They erected 5-star apartment-style dormitories featuring private ensuite bathrooms, hardwood floors, and granite countertops. They replaced traditional dining halls with artisanal food courts, offering organic, farm-to-table cuisine. This isn't higher education, it is a luxury hospitality engine operating on an institutional scale. When you audit the internal financial statements of an elite private campus, the operational bleed becomes painfully clear. The fundamental weakness of this business model lies in extreme fixed cost rigidity. Unlike a traditional corporation that can slash overhead during an economic downturn, a university's operating expenses are virtually locked in stone. First, there is tenured faculty, contractually guaranteed, non-negotiable payroll obligations that stretch across decades regardless of student enrollment numbers or department revenue. Second, there are the massive common area maintenance fees required to keep hundreds of acres of historic grounds and modern facilities pristine. Landscaping, HVAC maintenance on sprawling limestone structures, specialized campus security forces, and snow removal drain millions of dollars every single quarter. Compounding this financial drain are what analysts call zombie amenities, ultra-expensive, capital-intensive infrastructure built solely to impress prospective students during weekend campus tours. A $12 million aquatic center or a specialized digital media lab might look stunning in a recruitment brochure, but internal utilization reports frequently show these assets sitting idle with usage rates well below 12%. Yet every square foot must be heated, cooled, insured, and maintained 24 hours a day, 365 days a year. The capital required to sustain these non-revenue generating assets eats away at the institution's core operating budget, forcing leadership to continually raise tuition just to cover baseline facility maintenance. This creates a fatal liquidity trap when macroeconomic realities shift. American higher education is currently facing the demographic cliff, a sharp, predictable drop in college-aged high school graduates following declining birth rates following the 2008 financial crisis. Demographic projections from Nathan Gray show a nationwide drop of 15% in prospective college students starting around 2025 and accelerating through 2030, hitting New England and Mid-Atlantic private colleges worst, with drops exceeding 20%. As the pool of full-paid domestic applicants shrinks, tuition revenue stagnates or declines. Yet, because of built-in labor contracts and facility maintenance schedules, operating expenses continue to escalate at an average rate of nearly 7% annually. The net operating margin vanishes, turning into a structural operating deficit. To cover this cash flow gap and avoid tapping illiquid endowment funds, university boards do not cut back on luxury amenities. Instead, they issue tax-exempt municipal bonds, stacking millions of dollars in long-term debt service onto an already fragile balance sheet. The college expands its luxury footprint to attract wealthy students, but the resulting fixed overhead suffocates its net liquidity. When operational bleed threatens a private campus, they don't cut costs, they turn to Wall Street's favorite playbook. What Arthur Vance experienced on an individual scale is merely a microsymptom of a systemic financial disease suffocating elite higher education across the United States. To see the full macro picture, look at the bloody lessons learned from real-world institutional collapses. Consider the case of Sweetbriar College in Virginia. In 2015, despite holding an endowment of nearly $85 million, the board voted to close the historic women's college due to unmanageable operational deficits and declining enrollment. The alumni fought in court to keep it open, but the lesson was clear. Paper net worth does not equal liquid operational survival. Look at Hampshire College in Massachusetts, which announced in 2019 that it could not accept the full freshman class due to severe financial distress, forcing it into emergency restructuring. Look at Birmingham Southern College in Alabama, an institution with 168-year history that officially shut its doors permanently in May 2024 after exhausting a $30 million line of credit and failing to secure state bailouts. These were prestigious institutions with stunning campuses and dedicated alumni networks. Yet practically overnight, they found themselves staring down total insolvency, watching major rating agencies downgrade their municipal revenue bonds directly to junk status. The public was shocked, assuming an institution with $100 million endowment could never face a sudden bankruptcy threat. But what Wall Street analysts understood, and what prospective families failed to see, was that these elite campuses were suffering from a fatal asset-liability mismatch. To understand why a $100 million endowment cannot save a university from operational collapse, you must examine how university boards manage institutional capital. On paper, a college board will proudly advertise a massive endowment valuation to convince prospective parents and creditors that the institution is financially invincible. But an endowment is not a liquid checking account. Under strict legal frameworks like the Uniform Prudent Management of Institutional Funds, or UPMIFA, up to 80% of an elite college's endowment is legally restricted by donor agreements, earmarked strictly for specific faculty chairs, designated scholarships, or long-term capital projects. Furthermore, over the last 2 decades, university investment committees aggressively copied the famous Ivy League portfolio model, pioneered by Yale's David Swensen, heavily allocating capital into illiquid alternative assets, private equity funds, venture capital lockups, real estate trusts, and timberland investments. According to NACABO TIAA data, large endowments frequently carry over 50% of their total capital in illiquid alternative assets. These assets might yield impressive paper valuations on quarterly reports, but they cannot be liquidated quickly without incurring massive discounts of 20 to 40% in secondary markets. When monthly payroll comes due, or when a 6-figure debt service payment on municipal bond obligations hits the desk, an institution cannot pay those bills with illiquid private equity stakes. They require hard cash. When tuition revenue drops, the university experiences an acute cash crunch, exposing the reality that paper net worth means nothing if your net operating cash flow is deeply negative. This systemic liquidity trap was accelerated by Wall Street's influence over the higher education marketplace, specifically through the gamification of national college ranking algorithms. To maintain a top-tier placement in rankings like U.S. News & World Report, universities were forced to optimize specific structural variables. The algorithm heavily penalized colleges with higher acceptance rates while rewarding those that spent aggressively on instructional resources, facility development, and small class sizes. To fund this, institutions turned to a financial maneuver known as student loan arbitrage. Elite colleges realized that the federal government had effectively underwritten the entire higher education market by offering uncapped, federally guaranteed Parent Plus loans. While direct federal loans to undergraduate students are capped at $27,000 to $31,000 over 4 years, Parent Plus loans allow parents to borrow up to the full cost of attendance minus financial aid with minimal credit checks and no debt-to-income evaluation. Knowing that middle-class families like Arthur could access hundreds of thousands of dollars in government-backed leverage, universities continuously raised tuition to capture that liquidity. They essentially used debt-funded student tuition to service the interest on their own massive municipal bond debt. Students were no longer just scholars receiving an education. They were transformed into conduit debt vehicles used by institutions to fund capital expansion and manipulate national ranking metrics. This leveraged expansion worked as long as cheap credit flowed and the supply of full-pay students seemed infinite. But as debt service costs escalated and interest rates surged, the structural fragility of these business models was laid bare. Municipal bond markets began pricing in the reality that dozens of regional and liberal arts campuses were operating on razor-thin operating margins, burdened by debt service obligations that devoured up to 15% of their total operating revenues. When bond ratings drop to junk status, refinancing existing debt becomes prohibitively expensive, triggering acceleration clauses that require immediate liquidity reserves the colleges simply do not possess. The grand illusion constructed over decades of cheap debt and aggressive marketing shatters against the cold reality of cash flow mathematics. A $100 million paper valuation cannot protect an enterprise when its daily cash burn exceeds its real cash receipts. Surviving a structural liquidity crisis requires a brutal, unsentimental dismantling of non-performing assets. Look at the bloody lesson of West Virginia University in 2023. Facing a projected $45 million deficit, the university executed what higher education analysts called an academic transformation, cutting 28 academic degree programs, including entire foreign language departments, and eliminating 143 faculty positions. To pull back from the brink of bankruptcy, distressed higher education institutions must execute a comprehensive corporate restructuring that prioritizes immediate cash preservation over institutional vanity. The first and most painful step is dismantling fixed cost rigidity by performing a rigorous academic profit and loss audit. University leadership must eliminate low-yield, under-enrolled degree programs that consume massive faculty payroll and administrative overhead without generating sufficient tuition margin. By eliminating these non-viable departments, the institution releases tenured payroll commitments and immediately reduces baseline operational bleed. The second lever of structural redemption lies in aggressive asset monetization through commercial real estate arbitrage. A university campus is fundamentally a high-value real estate portfolio disguised as a school. Look at how Colby College in Maine revitalized its financial standing by strategically investing in downtown real estate development to diversify cash flows, or how institutions sell non-core residential real estate portfolios. To unlock immediate cash flow, restructuring advisors execute sale-leaseback transactions on non-essential land parcels and lease underutilized facilities to corporate or healthcare tenants. They convert underused academic buildings into specialized research hubs, medical offices, or data centers, generating steady commercial lease revenue to offset ongoing maintenance fees. Simultaneously, leadership shifts non-core lectures to hybrid or online formats, significantly reducing electricity, security, and facility footprint requirements. This structural pivot permanently lowers capital expenditure and transforms fixed property maintenance into a lean, flexible cost center. Finally, the institution must execute a total balance sheet restructuring with municipal bondholders and institutional creditors. University boards must negotiate distressed bond exchanges, extending short-term debt maturities into longer-term obligations to drastically lower annual debt service costs. Look at Oberlin College in Ohio, which engaged in severe spending cuts and administrative reorganizations to protect its core operations while maintaining its financial rating. Universities must establish strict debt covenants requiring a permanent liquidity buffer equal to at least 18 months of baseline operating expenses held exclusively in liquid cash or short-term treasury bills. By cutting non-performing academic programs, monetizing commercial footprint, and enforcing strict cash reserves, a campus transforms from a fragile, debt-laden hospitality engine into a financially resilient enterprise. Whether you're running a multi-million-dollar campus or managing your family's portfolio, the laws of financial gravity remain absolute. The ultimate takeaway from this institutional financial autopsy extends far beyond the ivy-covered gates of elite campuses. Whether you are managing a corporate balance sheet, allocating private investment capital, or planning your family's financial future, you must remain vigilant against status-driven leverage traps. In suburban America, the pressure to purchase social proof through inflated sticker prices and leveraged debt is a quiet killer of wealth. The core law of financial gravity is absolute. Steer clear of any asset whose ongoing maintenance costs consume more than its ability to generate net positive cash flow. Never trade liquid reserves for institutional vanity or unhedgeable status symbols.